This is going to be a straightforward test of a trading strategy suggested by one of you guys, one of my viewers. Anthony, he recently emailed me with a trading idea that he'd picked up from a successful trader, and he's been doing some testing with it himself. He doesn't yet program any testing or trading software, so he was testing it manually, which we all know takes a very long time. Anyway, the trading idea is looking at pound-yen Forex pair, looking at the first 4-hour bar or the first 4-hour candlestick on a Sunday, so the first bar of the week, then the majority of the time this 4-hour bar tends to close up. So I'm going to program this idea and we're going to test it. And if it works, then I'm going to try and improve it. But if it doesn't work, then I'm going to try and make it work. So if you're interested in this type of test, then stick around and look at the results with us. So the first test that we're going to do on the computer is simply buy the market as soon as it opens on a Sunday evening, and then hold the trade for 4 hours and then sell at the end of that 4-hour bar, which will be 2100 Eastern Standard Time. Now, to Anthony's credit, he's already noticed or already observed with the markets that around the open of the market, which is around 1700 Eastern Standard Time on the Sunday evening, he's noticed that the spreads of pound-yen Forex pair can be very, very wide. And he's noticed that with his broker, who I believe is IC Markets, that the spread can be as large as 15 to 20 pips. And looking at Oanda, we're going to be using Oanda's data, looking at their spreads, then it looks like we've got a similarly large spread up to 15 pips. I haven't seen more than 15 pips, but certainly up to 15 pips. And it's not until about an hour and a half or 90 minutes later that the spreads come down to a more regular, about 2.5 pips. So for that first 90 minutes that the market's open, the spreads can be very, very large. So this is something we do need to bear in mind when we start to analyse the results of this trading strategy. All of the testing that we're going to see is using Oanda's data, and we're testing from January 2008 through to the end of May 2021. Apart from the very first chart that I'm going to show you now, and then we're going to adjust it for more data. The first chart that we're going to look at, or the first test we're going to look at, is using data from January 2020 through till the end of May 2021, because that was how far Anthony had got doing his manual testing, and it looked promising. And that's when he emailed me to help out to do some more extensive testing. So let's have a look at that one now. So we can see on this chart that we've got data from January 2020 through till 12th of June 2021. It's actually only until near the end of May. And if we're looking at the chart, we can see it's not all that clear to see that this is a Sunday, but this is Sunday, and we've seen this first bar here, which is the first 4-hour bar or 240-minute bar, as we can see up here. We've bought on the open and we've sold immediately as the bar closes. And if we just scroll back, we can see literally every Sunday this is what we're doing. Okay, so let's look at the results. And that's the equity curve, and that's pretty good. It's certainly, moving in the right direction, and it looks promising. No wonder Anthony was quite keen for me to take a look at this strategy and analyse it a bit further. Let's have a look at the total trade analysis. And we're making money just over 66% of the time, so that's pretty good. We've got an average trade value of 5,700 yen. That's equivalent to 5.7 pips. So at the moment, we know we've got a massive spread when the market opens. So if we're only making an average trade of 5.7 pips, we're actually going to be losing at the moment because this average trade value is just not quite high enough. But let's take a look at the data. We're going back to 2008. So we know that first 17, 18 months worth of data looked pretty good. So let's have a look at the full data range. And there's the equity curve. We've just seen this very last part of the equity curve in the chart before, But looking at it over all those years, it still looks reasonable to me. It definitely looks like the behaviour of this market has stayed consistent throughout that 13 plus year period. So that's a good start. But looking at that average trade value, we've gone down even more now. We've got the whole data range. We're only looking at an average trade of 1.8 pips, which is nowhere near enough to overcome the trading costs. So the first test I want to do is looking at the time to get out of the trade. At the moment, we're getting out after 4 hours, but maybe there's a better time. So in this next workspace, I've actually done an optimization, and I'll show you the results. And I've optimized the end, I've called it end trade. That's when we exit the trade. And at the moment, we're looking at the exit of 2100, which is the 4 hours later. But what I've done is I've said, is there a better time from 1900 through to 2300? I haven't gone before 1900 because I've already mentioned that the spreads are pretty wild for the first 90 minutes of the session. So 1900 is 2 hours after the session begins. And in fact, 1900 is actually the best value here. Look, we've got the highest average trade at 2,700, and we're making most net profit at 1,900,000. So we're going to try to use 1900 and see what that does to the equity curve. And this is the equity curve using 1900. So we're buying on the open now, and we're holding only for 2 hours. So you could set up your chart to have a 2 hourly bars and exit on the end of that first 2 hour bar. And the curve is actually really, really nice. I prefer it to even the first one, but we still need to look at the average trade value, which is still only 2.7 pips. So we're still not high enough to cover those really high trading costs. But what if we got into the trade after those spreads become a bit more normal? I've mentioned that the spreads do tend to normalise around 90 minutes afterwards, which is 18:30. But that only leaves us half an hour within the trade, because at the moment we've got our exit set to 1900. But let's test getting in the trade at 18:30 and then getting out at 1900. And that's what we're going to see in this chart. We can see we've got an entry time of 18:30 and our exit time of 1900. Let's look at the equity curve first. And the equity curve's not as good, is it? It's certainly not quite as consistent as buying on the open. And what's it done with the average trade? Oh, the average trade is absolutely terrible. That's about 0.4 of a pip average trade, which is much worse than what we had before. So we know that getting in at the open does work best, and it seems to be consistent. But we're just battling those really large spreads. So what happens if we got in maybe the Friday before? The markets close at 16:59 Eastern Standard Time on the Friday, and the spreads do tend to get a little bit large towards the last 10 minutes of the market. So what if we got in the trade at 16:30, half hour before the session closes on a Friday? Well, I actually done a quick optimization on that too, and I optimized the start time from 16:30 to 16:50 in 5-minute increments. But we can see, unfortunately, everything's negative here. So that really doesn't work, does it? Because now we're holding over the weekend, and the original idea or the original edge has probably changed considerably, holding over the weekend. But what I have noticed is the later we enter the trade, so 16:40, 45, 16:50, this is on the Friday, that the average trade or all the results are actually getting worse and worse. So this gives me an idea. What about if we reverse the rules? Now we're holding over the weekend. It seems to produce a negative result. So what if we shorted the market at 16:50 and then got out on the Sunday? So that's the next thing that I'm actually going to try. So in this workspace, we're going to actually short at 16:45 and then exit at 2300. Why are we going to use 2300, you might ask? Well, if you remember, back in the workspace 2 here, we did an optimization on the exit time or the end trade for long trades. And if you look at 2300, 2300 was actually the worst, so 2300 I assume will be best for short. So let's have a look at the results for shorting at 16:45 on the Friday afternoon and then exiting at 2300 on the Sunday. Well, the results are positive. Look, the equity curve's nowhere near as nice as some of the earlier behaviour that we've seen going long, but it is positive. The total trade analysis is one of the highest yet at 4.1 pips. But I do want to just check that end time because maybe 2300 wasn't the best. So I've run an optimization looking at the end time. But in this case, I've actually looked at times that run into the following day, so early hours of the Monday morning. I wanted to start here at 18:30. 18:30 because we know that the spreads come right down at 18:30. So anything after 18:30, we're looking at a lower spread. So if we've got an exit here at 18:30, 19:30, 20:30, these are all on a Sunday evening. And the minute we see 30, that's 12:30 on the Monday. So that's an hour after here on the Sunday night. Okay. And looking down at the results, we can see that the best results are here, which is 12:30. So that's midday or 30 minutes after midday on the following Monday. So now what we're doing is we're entering at 16:45 on the Friday and then we're exiting on the following Monday. So we're holding the trade for far, far longer. And don't forget, this is a short trade. And that's what the equity curve looks like. We've got an extremely strong early time through 2008, 2009, even going right through to 2013. But then essentially it just goes flat. I don't particularly like this equity curve. Looking at the total trade analysis, looking at the average trade value, now this is more like it. Now we've got an average trade of 11 pips. So considering that we're entering the market and exiting the market when the spreads are at their normal or at their lowest, this might be something quite usable, but I just don't like that equity curve. We've started to get away from the original strategy idea, by looking at this short selling version. But this is what happens when you start to study the market, start to look at a particular idea and realise that something gets particularly bad, and then you end up reversing the rules. And I've actually created decent strategies that are almost the opposite of my original idea, but that's just what happens. And if you're enjoying this type of video, then please hit the thumbs up button now because that really helps. And if you'd like to see more of videos just like this one, then let me know in the comments below. I then looked at putting the rules back to buying at the open, understanding that we might have to pay this big spread, and then exiting at 1900. That was what the best equity curve looked. And I introduced some different trade filters. If you've watched any of my videos before, you'll see the kind of filters that I tend to use. I tried about 6 different filters and nothing particularly worked very well. Nothing brought that average trade value up high enough to overcome those trading costs. And then I knocked back the exit time. Rather than exiting at 1900, I pulled it right back to 2200 to give us more time in the trade, to give us a chance to get a bigger move, to get a bigger average trade value, and then tried the filters again, but unfortunately still nothing acceptable, nothing that really worked. And although this strategy was originally designed for pound yen and the idea, the behaviour clearly works, Anthony also done some testing on a couple of the other major pairs, and looking at the spreads around sort of open times on a Sunday, I noticed that euro dollar had the narrowest spread of them all, but that could still be up to about 10 pips. But I thought, let's investigate that. So in this next workspace, we're going to look at the original rules, which were buying on the open and then exiting 4 hours later or at the end of the 4-hour bar. So this is the chart of euro dollar, you can see up here, and the 4-hour bar, 4-hour bars or 240-minute bars, and we're buying on the open and exiting at the close. So let's have a look at the results for that. And looking at the equity curve, it looks pretty disastrous. Although Anthony tested this with some success, but remember, he was only testing back only about 18 months, and in fact this last period from probably, let's say, the beginning of 2018 perhaps, has actually started to work quite well. But looking at the overall picture, euro dollar certainly hasn't behaved this way over those 13 plus years like pound yen has. And I'm yet to take this study on euro dollar any further. So unfortunately, we haven't got a tradable strategy. Well, it is tradable, I suppose, but you won't make any money from it. We've learned that trading costs, particularly the spreads and the varying spreads at different times of the day, they can play a huge part in the profitability of a strategy. So you must be very, very mindful about those, especially with strategies with such a short trade duration like this. You know, we're only looking at 2 hours, 4 hours in the trade. If we were looking at getting in and then exiting 3 weeks later, we would have much more chance of making a big chunk of profit, and that 15 pip spread might be very insignificant, but it's hugely significant when we're only in the trade for a matter of a few hours. And perhaps you've already heard of this strategy before, and after you've seen my test results, I might have saved you some money from trading this strategy and being eaten up by those trading costs. And I mentioned earlier, if you've got any trading strategies like this that you'd like me to test, then let me know, leave them in the comments, and let me know if you find this sort of testing video helpful, because most strategies don't work. And when I make these videos, I normally only pull a select few strategies that actually do work, because I only want to show you good strategies. But perhaps showing you strategies that look promising and kind of picking them apart and showing you why they don't work, perhaps you're interested in that too. I don't know. You let me know. Let me know in the comments below. Anyway, although this wasn't a usable strategy, I hope you have enjoyed the video. And until the next one, this is Jared Goodwin, and thank you.